Joining us now, Renaissance Macro Research Chairman Jeff deGraaf. Jeff, great to see you. I'd love for you to put yesterday's jolt into some perspective here. Market kind of found itself a little bit wrong-footed about that CPI number. You think it changes the overall cadence of this market?
I don't. One-day events are pretty tough to extrapolate out. Usually if you've made a low and you're in sort of the space building process, which we really do think that we're in, those one-day events tend to snuff themselves out pretty quickly. And so I was encouraged by today's action. Again, one day is hard to extrapolate, but certainly think that that it is one of those types of sort of extreme events that doesn't have follow through, and that tends to be good news, not bad.
Well, you mentioned that you've been thinking that the market is building a base with the June lows being relatively important. I know you've been kind of respectful of that low and how the market behaved coming out of it. What could we look for as part of that process? I mean, in particular, I know you've been looking at the historical analogies, things like the year 1962, which has got some, I guess, echoes today.
Yeah, I mean, I think there's a lot of concerns about inflation, rightfully so. I mean, inflation is really a dark cloud over equities. But I think it's really important that people keep in mind that it's not about good and bad in the market. It's about better or worse. And it does appear that inflation is getting better. And one of the things that we're really encouraged by is what we're seeing from the PPI data and some of these early input costs. We look at inflation or CPI as really being the pig in the python, if you will, from COVID and supply chains and everything else. And you're seeing that in those numbers. But if you look at what's on the menu, what's, for dinner for that python today, and you look at PPI, which are early input costs, those are contracting, and they're actually in a pretty bullish zone. So I think inflation is going to look far better out the next 6 months. And I think the markets and the Fed will start to see that, and it's going to be more respectful of that transitory inflationary environment that we really probably will prove to have been in. It was just a little longer transition than, maybe people were more comfortable with.
And then if we come out of that inflation panic, this prolonged idea that was enemy number one, are we going to go right into, it's time to prepare for a recession? What's the market telling you about how those risks are being absorbed?
Yeah, that's a mixed bag. It's a really good question. It's a mixed bag. I mean, if we look at tech, it's saying that, good things are not on the horizon. If we look at industrials, it's actually saying that, industrials are acting better than you would expect. We're seeing financials on a relative basis act better than we would otherwise anticipate on a relative basis. The tricky part of things like utilities part of the leadership structure of this market. Energy is still part of the leadership structure of this market. Those two areas we would expect to fade, but we're not seeing it in the relative performance yet. So we're not pulling the ripcord on those areas yet. But I would expect to see more improvement in discretionary, deterioration in energy, deterioration in utilities, if that script's going to hold. And then we start to see these momentum confirmations, 20-day highs, the percentage of issues above their 20-day moving average, making breakouts, getting through that 200-day. All those would obviously be incremental steps into building the early foundation for that next bull phase.
I know you've been pointing to this pretty stubborn kind of aggregate negative sentiment that professional investors, speculators seem to have against the S&P 500. It seems even the bears can grant that, institutional positioning is not very bullish right now. Is that enough when you're in a regime that says don't fight the Fed?
Well, we've looked at that historically, and the regime analysis is mixed. But when we look at it on where we are with the inflation data, we actually find that the returns are better when the Fed's hiking in this inflationary regime that we're seeing, because essentially the market's saying, hey, look, they're on top of it, they're getting it. And so it might take some time, but we're easily halfway through this inflationary Fed tightening cycle. And so the market will start seeing through that. And I think the data is going to be bad for the remainder of the year, but we know that the market will see through that the next 6 months, maybe even 9 months forward. And that's why we think that things will start to look better. I do think there's going to be a growth scare. I actually think bonds are really, really interesting right here, because I think there will be a growth scare that the Fed has this proclivity to overdo things. So I'm really actually encouraged by what we're seeing out of the bond market, and believe that we'll see a contraction in yields here. But that's how we're positioning and how we're seeing it. The sentiment isn't enough by itself, but when you marry that with momentum and the improvement in trends, that's actually a lot of dry powder that can help fuel those early stages of the advance, where the quote unquote easy money's out there, and that's what we're setting up ourselves and our clients for right here.